For those of you who missed breakfast, we have some numbers to crunch this morning, so I'm going to offer that up. For those of you who had a late night, I'm going to apologize because this might be a little heavy for you. We have a great panel today. We're going to start after some brief introductions. We're going to dive into a few numbers to at least put the boundaries of some ideas out there about rates and about YieldCo, because there's a lot of conversation about at what rates are YieldCos buying and to what extent is that influencing the market. And so we're not only going to talk about rates and investment, but we're going to drill down hopefully into more M&A broadly and have a conversation about what's really changing in M&A as we sit here at the end of 2014. And in a way, not to be too corny here for the first panel, but I'm hoping that we're going to test the proposition: is low-cost capital the no-brainer of aggressive M&A in today's market? So before I ask each of the panelists to give a quick overview of themselves and their organizations, we put a panel together that had a public YieldCo that's out and well-known and aggressive. We took the other side and at the end in Rob, and we have a company that's very much been funded with private capital and is operating across the M&A landscape. And then in the middle we have two interesting companies that have been private and have been forming. Whether they go toward a YieldCo or some other capitalization probably is an open question. One of them, I think of S-Power more of a traditional IPP in the way that it was put together. And RET, I think of as a company that was originally created as an REIT model, very traditionally as a YieldCo, and how it evolves and comes out in time. So with that as a sort of a comparison and contrast of our speakers, let me ask each of you to introduce yourself and a quick overview of your view of the world and your organizations. Zaina?
Sure. Thank you, Terry. My name is Zaina Alazi. I'm the Vice President for Business Development at SunEdison. I'm focused on North America acquisitions that are pre-COD, so pre-operating assets. And as you might imagine, SunEdison being quite a large company, we have people within the organization that are doing M&A both pre and post COD for both our yield vehicle, which is Terraform Power, as well as for retention or otherwise sale. So we really run the gamut in terms of our M&A interests. And we are purchasing both projects and companies across the board, both that have megawatts that are attributable to the yield vehicle, as well as just generally speaking, very active in the M&A market for building our business and our platform. SunEdison is a vertically integrated company, publicly traded company. We do everything from manufacture panels and technology all the way through downstream business. We do residential, we do commercial and industrial, and we do utility scale projects. And we're also a global company operating in 3 major regions across the globe and continually growing. So Terry, I didn't know how much more detail
That's perfect.
you wanted.
Except the color of your shoes. Do you want to elaborate on the shoes?
Well, I'm a UT Longhorn, so I have to represent when I come here.
There you go.
Thank you very much.
There you go. That's it. Thank you. Chip?
I'm Chip Everest, founder and president of S-Power. My prior history is building big businesses from small businesses. We've built a nuclear services business that from 200 people to 6,000 people globally. We exited that business about 2008. And then we started this business in 2012 with 10 people. And now we bought the assets of Tioga, and we also recently this year merged with Fir Tree, an investment fund in New York. They had control of the Silverado pipeline. So starting 2 years ago with basically nothing, we now have about 200 megawatts under operation, and we have 950 megawatts of contracted pipeline. We're buyers as well. We buy projects that are in various stages, all the way from early permitting stage to pre-COD to operating. We have operations in the UK as well, and so we're a traditional IPP, meaning that we have assets. We're private, and we hold assets as long as we need to. We're all about optionality. So, if we have the ability to do a YieldCo, that's great. If we don't, that's great. And at the end of the day, we're building a company with, assets that are yielding 8-9% unlevered, which, for me, that works all day long. So love the business model, love the industry, and that's us.
I'm Christian Fong, one of the co-founders and the CFO of Renewable Energy Trust. As Terry mentioned, a not yet public YieldCo. The YieldCo model was one that we identified as a standalone business model before NRG coined the phrase, or Wall Street coined it for them, what a YieldCo was. 4 years ago, when we founded it, it was really about addressing the choke point of finance into the middle market. At that point, we identified the real estate investment trust, the REIT structure, as a probable solution for what a YieldCo might be. Clearly, the market has moved on. The standalone C Corp YieldCo is now an established model. We are funded by Blue Mountain Capital out of New York, just another one of those multi-billion-dollar, more money than God hedge funds. We've got about $250 million of committed capital, both for operating assets. We have announced the acquisition of about 40 megawatts of projects. We do have about 250 megawatts in various stages of closing. And those are both operating projects, which we own, as well as in both the United States and Canada, a number of projects that are pre-COD, in some cases pre-NTP. We are aggressive buyers of projects. We think of ourselves as both a project finance shop as well as a corporate finance shop, which is interesting to this panel because the intersection of project finance and corporate finance is an unresolved, presents some unresolved questions that this panel, I think, will be getting into.
And Rob.
Great. Hi, I'm Rob Macinter. I'm the Chief Operating Officer of Main Street Power. I've spent the last 6 years or so in the renewables and energy efficiency businesses. Initially raised private equity capital to do a roll-up in the mid-market ESCO space. Spent a couple of years running Advanced Energy's inverter product management, and the last 8 months at Main Street, where I'm responsible for our business development and asset management operations functions. Main Street's a turnkey developer, project finance shop, and long-term owner of the assets. We've got about 55 megawatts under management, most of those weighted in commercial DG type projects, but we also are a wholesale residential financer. We're sort of behind other installers and marketers, part of that ecosystem that Shale was describing yesterday afternoon. We have another 50 or so projects megawatts of projects under control right now. We focus primarily in the U.S. We're active in the Caribbean as well, and starting to look a little bit more broadly at non-U.S. jurisdictions.
Okay, that's great. So I want to introduce just a few numbers because most panels you tend to talk around the ranges, and I appreciate, Chip, you putting out there the kind of return that you're looking for in the portfolio. And the real subject of today is, not just what is the cost of capital, which is getting the deal done, but, is M&A different today because of that lower cost of capital, or is it the same, Back to the Future idea where it's about other things equally as much. So I have about 6 slides, and they're really more detailed than necessary for you and your take-home package. I'm going to skate through them and really land on one, and then come back and ask the panel if this is the way they see the world. The sort of the takeaways as an investment banker is that I care about is an asset is the valuation method is going to come up, whether it's an unlevered rate of return or a levered rate of return, or if it's a cash flow multiple, they're going to come up with dramatically different answers depending on whether that escalating profile, but the PPA has an escalating profile or flat, and that's a pretty nuanced idea. I think it's probably understood by many, but it's a very nuanced idea because it winds up, determining 5 to 10% valuation between one bidder and another, which gets to the second point, which is all about structuring. when we're in an M&A process, we don't always see the final structured product, but these guys all have a lot of levers that they're not going to tell me about. They're certainly not going to tell you about if you're selling an asset to them. They have a lot of tricks in the bag. They have a lot of ways that they're looking at tax equity monetization and all the attendant intercreditor agreements that go with that, and indemnifications and stuff. They have ways to view leverage or the optionality to view leverage in the future, whether they back lever or lever up front. And they may view cash differently. So there's a lot in that, and we couldn't possibly cover it except that it's got to be noted. And then lastly, the profile of the cash flows matter, and that's really the purpose of these couple of slides. And I'm going to go right to the numbers here. This is about a 20 megawatt project, and I picked just 4 methods to value to highlight a point, not the absolute number so much as the relative order of magnitude. In method 1, it's a traditional unlevered discount rate. It's got the 2 bars, 7 to 8%. And on this particular generic project, has an escalating PPA, and we could see a range somewhere between just below 2 to just below 7 for this particular set of cash flows. That gives you the spread of what 100 basis points of capital is doing. Method 2 and 3 zero right in on the near-term cash flows. And 2 is a good old traditional accretive dilutive analysis. If you're going to buy something and issue stock, what's the rate that you would pay? And part of the question in there is what's the dividend growth that's locked up? You can see how tightly that valuation gets constrained when you start to look at the structured cash flows or the cash available for the investors. It narrows in the answer quite dramatically. The third method is a bit irrational because it's just the dividend rate. It's that first year cash flow divided by dividend rate. And we know that that's not the way deals are done because there's got to be a growth on that as well. But you can now see how dramatically widely variant and dependent those near-term cash flows are in valuation. And then the last number 4 looks at structured cash flows. Again, it's looking at the dividends and it's putting a weighted average discount rate on it. When you look at these materials, you'll drill into the nuance. But the point to this panel is, wow, we're taking a project to the market and we got all these different views of valuation. And so, is that real in your mind? I mean, please elaborate on this. Zaina?
Sure, I'll
From your
start.
point of view, is that the way you see the world?
It's very real in terms of the different types of methodologies that one might look at in order to look at a deal. And I think one of the missing pieces of information are what are the details of the deal and the project and the PPA and what other risks are involved in that particular deal. And that might lead you to look at it in a particular one or another of those buckets, number 1. Number 2, another metric that we use quite regularly at SunEdison is cash available for distribution, which is a huge indicator for us in terms of how we're looking at value for projects, especially as they become later and later term in the development period and closer to COD.
So risk matters. Do you have a risk conversation around cost of capital? Do you inside SunEd say, that's a higher risk project? My gut in your investment committee goes, I need 50 basis points more because of that risk I'm picking up. Is there that level of conversation?
It's on multiple levels. I think number 1, risk matters in terms of the size of the project.
Okay.
Meaning, is it a distributed generation project or portfolio of projects? It also matters the stage of development of the project. I think the later stage, the more likely we are to become a little bit more aggressive in terms of the amount of risk that we're able to stomach. And the earlier stage, the more difficult that conversation becomes.
Chip, how about you?
Absolutely. I mean, we have the same discussions. Kind of the new things that are kind of being talked about are you giving value to revenue stream post PPA?
All right.
And so that's kind of a new topic for us, to be frank. Are there SRECs involved? Are there state tax credits involved? And what source of tax equity are we going to use for a specific project and the costs associated with that? A lot of levers and a lot of things to be discussed. But same with SunEdison. I mean, if it's closer to COD, the risk parameters obviously come down quite a bit. If it's pre-NTP, then we're not willing to pay as much for it typically.
And so Chip, you brought up the terminal value, which, is the new big idea in the market, and from my experience, it's been coming on, but certainly in the last 3 quarters to a year, it is showing up more and more and more. Of course, owners have always thought that there was terminal value benefit. Talk a little bit about that. I mean, how are you, have you guys developed a view when you look out in the market of the future rate of power? I mean, you're picking up a big risk, and it has a big value on the margin.
It does change the value quite a bit, actually. And as long as you control the land underneath it, the project, we believe, will continue to generate revenue post-PPA. Then, the discussion then is like, at what rate? Is it like at a QF rate? And does that escalate? And, a lot of differences of opinion, even within our own company on that.
Right. Okay. What do you think?
This is certainly the main constructs here. I'd maybe add a few things. The residual value is increasingly coming up, but the challenge of residual value is that the public markets they're apparently not thinking about it. Maybe you've got some analysts in the ivory tower part of a Wall Street shop writing analyst reports thinking about it, but the investors seem to be working off a CAFD multiple or a dividend multiple, more simply. And so part of the challenge is, when are you going to step back and say, as rational long-term participants, with both Chip and I are thinking, we're going to own these things for the next 20, 30 plus years. We're going to repower them. We're going to, everything about ownership. We don't necessarily get to just think about, how do I arb the market right now, which is much more of, I'll say, not in a pejorative way, but the developer gets to think about, how do I arb the inefficiencies of the market. We have to think, well, maybe in 5 or 10 years, they're going to revert away from CAFD multiples. That would be sort of the dividend yield valuation, to a more traditional discounted cash flow method for. And there's pretty dramatic differences in valuation, and the application of things like residual value applies in one but not the other. So inside our shop, we are not only thinking about what are the public markets trading at right now, that is, what is the arb to the trade, but how badly could we get hurt if the market rationalizes and begins to go a different direction.
I want to, before we go to Rob, I want to highlight a point that you said that's really important, and I don't think it's understood by many in the market, is that the DCF model takes into account the terminal value,
Yes.
because it's this big lump out there. The other methods, in method 3 and method 3, which is, if you take, say, Morgan Stanley's equity research, and you read it, it's very much the way other energy companies are being in the oil and gas sector being evaluated. So we're looking at the long-term steady growth of cash. Solar assets are declining assets if you believe degradation, and it's either balanced by an escalating PPA or it's not. And so if you're looking at dividend growth and you're saying that there's yield plus dividend growth, we would expect all of the YieldCos to get very tight in their valuation, to be separated by 102 basis points between each other, if you believe the lesson from the other capital markets.
But there is an unnatural thing that's happening also in the market, where you would think a PPA with an escalator, because your costs are escalating with inflation at least, right?
Right.
But today, people are favoring flat PPAs because they're higher yields today. And so, that doesn't make intuitive sense to me.
Right. So we'll bookmark that. I'll come up to it after Rob tells us whether, is this the way you look at it, as more of a private structured guy, and can you compete in this world?
Well, first of all, I'm going to give a disclaimer that as the ops guy on the panel, I'm not going to be prepared to opine deeply on all of these different valuation methodologies. I'll note that that Main Street is partnered with Morgan Stanley. So that Morgan Stanley is our project finance partner. We essentially co-develop projects together, leveraging Morgan Stanley's equity capital. So when we look at returns, we typically start with an unlevered rate of return on the project. We're targeting certain IRRs, but the project needs to be able to support Morgan Stanley's return for providing a full capital stack to a project that is pre-development capital, construction capital, and then ultimately sponsor equity in the permanent takeout. We look at projects pre-NTP, and we're starting to look at projects even earlier in the development cycle to see if we can add value to an early stage developer. The fee that we're prepared to pay is going to be a function of how well developed is that project, are there risks with the project, what's the geography of the project as we start to move outside of traditional U.S. jurisdictions. Obviously, there's a whole new set of risks.
But you're doing the
geopolitical
gut
risks.
check on risk, and you're saying to Morgan Stanley, we've checked this out, here's our mitigation strategies, as you would say, Zaina, because I know you have to sit in front of your investment committee and tell them how you're going to answer every one of their gut checks. But you're doing that. In this case, you're doing it to an investment committee that's going to buy SunEdison that wants to buy at, think of it as a wholesale rate. They're not going to always buy at the YieldCo rate. I mean, I don't believe you shop with YieldCo money.
Well, first of all, it depends on what you mean by YieldCo rate.
Right. It's one of those.
So
down
which
there.
one of those are you talking about? But no, I think-
Dialing for dollars.
No, I think the answer to that is no, because ultimately the YieldCo rate is for fully de-risked operating assets. And
All right, fair enough.
in order to take on a project that's pre-COD, there's typically work that remains to be done. That is a risk to SunEdison, and therefore we should see value for taking on that risk.
So Rob, back to you then. Morgan Stanley's probably got a rate of return that wants to take on more project risk. So you're getting involved earlier. You're not coming in to compete at the late stage, fully structured. You're the shop that wants to take that structuring risk and wants to take the development risk.
Absolutely. I mean, we're not a YieldCo. We're not a buyer of projects at COD. We get involved much earlier. And so, the market is big enough and fragmented enough that there's, I think, many sectors in which COD buyers and YieldCo players can play, as well as, DevCos and earlier stage players such as us.
Well, so I'll make a point, and then I'm going to come to pick up Chip's point. But so if this is a 20-ish megawatt asset, and say it has some DC overbuild, but you're looking at 10% of the equity value on the sliding around. My gut is in 10 or 15, depending on how you look at it. There's a lot of that's a huge number. So if you thought about M&A 3 years ago when this conference first started, my gut would be you'd be talking about the same kind of numbers. And so there's a pause here to say, are we really in a different world given the YieldCo capital rates are so low or not? Is it that all players have shifted down to a new world that reflects lower interest rates, that reflects utilities back in the game, unregulated utilities buying assets? The question is there an unlevel playing field, or is it just that the absolute level of returns has shifted and everybody's still playing at the same level? So I'm going to ask you guys to reflect on that, but before I'm going to go to Chip's point, and the purpose of this slide, and maybe Christian, I'll ask you to come back to this later, but the difference between 1 and 2 is that if you're maximizing yield, it's all about a lot of leveraging, a lot of structure with tax equity. It's not a cash flow optimization game. The optimal YieldCo public valuation multiple answer is not an optimized yield, and the two are not the same. And so we'll get into that in a second. In this slide, I took the same slide from before, but we took the same set of cash flows and we said, let's create a flat set of cash flows. In order to create that, we kept the present value neutral at 7%, which is why in the top slide, on the right-hand side, you see unlevered 7%, because these two profiles are identical at the same levered rate. Now look at how the answers change when you look at the gray bars or the light blue bars, which are now levelized, which means there's a lot more cash forward, and look at the dramatic answer here that's on. So when I look at this, I have to believe, Zaina, that you guys are talking about risk and return, but you're also saying, which of these do you value an asset at? I mean, there's a lot of discrepancy in how these numbers can be pushed around. And how do you handle this tension? And to kick off, and then Chip, maybe you can reflect as well on how you were looking at the difference between two profile cash flows.
Sure. So I think it's very much a conversation that we have on a case-by-case basis.
Okay.
It's based on, the project, the particular profile of the cash flows, the risks associated with those cash flows. Are there SRECs involved? Are there not SRECs involved? Are they front-loaded in terms of cash flows?
So the quality of the cash flows.
Is the project in a market where we can become more aggressive in terms of our residual value views or not? Is the project going to be one in which we lever heavily, if there's enough cash in the project to lever it heavily, or not, and still be successful at acquiring the project? And I think, all of those things factor into, the methodology and how we view a particular project over time in terms of, being able to structure it in a way that shifts cash flows from one perspective to another.
Do you have a
more
dual
evenly.
lens as you're looking at assets at the investment committee? Do you,
We-
have the risk conversation and the details, but you're also going, look at these two lenses?
We have probably 10 lenses
10
that we're looking
lenses?
things
You want
at
to tell us
right
about
now.
those?
I think I'll reserve that for another conversation.
I believe it that there are 10 lenses. I believe it.
There are quite a few.
How many for you guys?
Same way. I mean, we have 10 lenses as well, and 10 different views, on the investment committee. Because we're a long-term IPP holder, we probably give more value to the unlevered discount valuation than we do the EBITDA yield. Just because, at the end of the day, we're going to be valued on these assets over time, not for an immediate gain with a YieldCo. So I would say we're probably more towards, we definitely look at both, but I would say number one is probably still my favorite at least.
You feel sleep better at night.
Yeah.
When we think about it, and maybe I'll take a step back, Renewable Energy Trust is not built on the acquisition model. It's really built on the partnership model. From the beginning, it was identifying that the middle market does not currently have access to capital at the lower ends of these ranges. And it's about trying to find partners, whether they're what we call asset partners, and you're able to do repeat transactions to try to move closer to the low end of that range. Or sometimes we refer to them as full-scale strategic partners. We're essentially saying, hey, we'll just pass through we'll get to the far left and further, if possible. Wait, is the left the high
Far right.
price? Far right. We will pay absolutely YieldCo
But for a turn, the kingdom was
prices.
lost.
I know.
Forget about wholesale. We are actually built to be the pipe that delivers capital at that cost of capital to our strategic partners. Our goal as a company is to not buy at wholesale, sell at retail. It's to deliver the cost of capital and as much of it as possible. Call it the Walmart of YieldCos, right? We're not trying to make money, we're just trying to do it in volume. As a result,
We're trying to make money, but
as a result, we end up thinking, call it method 5.
Okay.
It's saying how much of this set of projects or how much of this partner's business could be valued at full YieldCo rates, and let's give them that value, and then have a rational discussion about why the rest of it isn't YieldCo-friendly product, whether it's the variability you showed in the last slide or a location problem, and how can we solve that with them? Now, there are some cases where it's just not going to be a fit, or the partner isn't interested in doing that sort of sum of the parts analysis, but we do want to get as much of far right profitable to the developers as possible, which means a little bit of a method 5 of slice and dice.
Like in New England, you would view the SRAC as more speculative, type return, but there's a core capacity value that's in there. Do you apply differential cap rates inside a set of cash flows?
Absolutely. The investment committee, of which I'm a part, will frequently look at and ask our teams to look at what are YieldCo-like or fixed income-like product, and they'll have to color code it and say, here's the color-coded bar graph for now till then, and we can apply YieldCo type cost of capital there. Here's the stuff that didn't quite work, and it's a different cost of capital for our teams, sum of parts.
Rob, are you parsing risk like that when you think about how you guys are looking at whether you want to do a deal or whether you're leaning into it or you're pushing on the value?
I mean, we have to take a number of issues into consideration. I mean, as I mentioned earlier, Morgan Stanley is our source of equity capital, and as an investment bank, they're subject to regulatory reg cap requirements, reserve ratios, and that sort of thing. So we have to be sensitive in terms of the overall returns on the project that those are going to pass through Morgan Stanley's own investment committee. And then secondly, when it comes to issues like SRECs and playing in those markets, I mean, we very much value those incentives. We have to look at are those incentives something that we can enter into a strip so that they are more attractively packaged to a debt provider as we bring debt into the mix. And so those are some of the ways that we manage and look at those kinds of risk factors.
So let's back up then and look at this slide. There's a lot going on in there in terms of at least this profile. We're sort of entering a conversation where we're parsing risk. We're thinking about capital rates differently. How are you guys thinking about leverage in a world where interest rates are sitting where they're sitting? And Chip, sort of to your point, I often wonder that if you're raising equity capital today at very low, presumably lower rates, and you have an outlook on a set of cash flows, and you're not really getting to feed at the level that you want until post-ITC or to post-tax structuring, and to the extent you've got a tax player in there who's trying to get their real return, you're pushing yourself back in those cash flows, and by the time those cash flows show up, interest rates could be 300 or 400 basis points higher. How do you have that conversation? How do you think about that? And you may have bought stuff with really cheap capital and overpaid, and have a real return at that point that looks, questionable on the margin.
Right. We worry about rising interest rates for sure, and we have an internal discussion all the time about whether or not we should lock in leverage for 15 years at a fixed rate today. We're still debating that right now.
How about the rest of the panel? How do you guys have the debt conversation? And does it impact your M&A? Are you thinking about drinking more from the fountain today because, holy cow, you got to get it while it's good?
So I'll jump in and say that it's both a conversation that we have with respect to debt, and it's a conversation that we have with respect to timing regarding the ITC and the expiration of the ITC. Meaning, speaking of drinking from the fountain now, now is the time to be doing that. But on the other end of the spectrum, we've got this push and pull of, tax equity becoming more squeezed, and the availability of tax equity becoming more expensive, and making sure that we are able to execute on all of those projects prior to debt rates going up and the ITC expiring are all factors that we take into account regularly.
I think beyond that question, certainly we're thinking about debt and where interest rates go. When I look at these two cash flows, if somebody showed me a single asset that looked like Structure 1, now that's clearly not a YieldCo friendly set of cash flows. You have to pay dividends, and in years 6 through 19, I'm not sure how you're going to pay dividends when there's no cash flow.
All right.
But if you buy one of those and 10 of Structure 2, you might be able to get away in the public markets paying a dividend multiple, a cash flow, or a CAFD multiple on Structure 1. The challenge will be that buyers will say, could I be your 1 of 10?
Right.
They don't want to bring
This
the
is
other
a
10.
huge issue. This is a huge issue right here.
And so if somebody can bring me 10 of number 2 and say, I've got this one over here that was kind of funky, can you take it with it? Then we probably can, and probably most YieldCos in this space would be able to overlook that there's 1 of 10 or 2 of 10. Now, and my point to where's the transition in the market going to occur? It's right now you can get away with, someone, equity capital markets guy in the room can say, how much could you do of 1 versus 2? You can get away with a lot more of number 1 right now than in a normalized time in the market. Investors will overlook the fact that in years 6 through 19, funky things are happening. So I'm not thinking so much about when will debt rates go up 100 basis points. I'm thinking about when will equity capital markets flip over and start to say, we expect everything to look like Structure 2. We're no longer willing to overlook that a bunch of your deals have this Structure 1 in it.
This is a huge issue. I mean, I don't mind saying that the Solar City Roadshow, when it was out a couple of years ago, it was pretty clear that they were taking a 5% equity valuation on terminal value cash flows post debt structuring. First time I've ever seen that as an analyst in my whole career in energy. And Wall Street bought that. Now that's a different market segment. That's residential, and there are different dynamics going on there. But this 1 in 10 is a very important idea. I mean, you have high growth rate on the street, and not to put you as a public company representative on the spot, but I do want to put you on the spot.
Right.
Will you buy one project differently than another? Because Zaina did her work and said, I got these risks because here I'm going to mitigate, and here's my valuation based on every other deal I bought through the door, but there's this extra conversation I'm going to have. And by the way, this looks really good for that hole and this hole and that hole. Is that conversation happening?
We look at everything on a portfolio basis. There's no time ever that we're looking at one deal at a time. So every time we have a conversation, whether it's with our internal investment committee or with Terraform Power, the question is, how does this fit into our portfolio?
Oh, so every deal, that's
Every
interesting.
deal.
So each one gets brought into the portfolio as you take it up to committee.
That's right, and
Wow.
that conversation is easier if the project is attractive,
Yeah.
and much more difficult if the project looks like Structure 1. Or any other variation of 5 other project structures that look terrible right now.
Let me do a quick check in the audience because I have a couple other questions that I want to jump into, but raise your hand if you're going to ask a question, because if there's a lot of questions out there, I'd love to feed them. So no questions. Wow. You guys must have had a late night.
Got one right there.
Okay. So we've got a couple. So I'll make sure I reserve it because we've got about 8 minutes here. So then let's step back to the big picture. And I think the GTM crowd, we appreciate leading off the day with this panel because there's a sort of interesting question. Are we at a different world on M&A? Where are we at the end of 14? What have we just come through, and what are we looking at? Because we got a 2-year run from the roses before the step down begins, if in fact it begins at the end of 16 or the beginning of 17. But have we characterized it right? So I toyed with the idea that low cost capital is a no-brainer, but I was sort of joking. I don't really think it is. I think we've just moved the conversation down a couple hundred basis points, and it's business as usual. Right or wrong on that view?
I'll jump in.
Yeah.
I'll say, first and foremost, I think Main Street Power and Morgan Stanley, our cost of capital is not the lowest cost of capital. So why would anybody want to do business with us? I mean, it's a big market. It's a fragmented market. We try to reach out, and we're very quick to move and to make decisions. We have available capital that we can deploy very quickly, and we're willing to do that in a pre-development mode for the right project. And then you don't have to ever worry about construction project finance. So we have a lot of tools in our quiver to be able to work with folks that want to move quickly. We're absolutely, I think, all of us are playing a portfolio. We operate in different sectors of the market. In some cases, we overlap a little bit. But I don't think that cost of capital is the sole decider in terms of project M&A going forward. It's very much about a partnership model. It's aligning with somebody that you could do business with and then hopefully do business with again. And I think we try to bring that mindset because ultimately we will be the long-term project owner. So we're trying to do business with people where they're capable of putting forth a high-quality project, and with EPCs that can deliver and wrap a project that's going to produce, in excess of expectations for the 20-25 year life of the asset, and then hopefully we'll enjoy some terminal value from it post-PPA.
I would echo the same thing. I mean, we are definitely not the lowest cost of capital either. I mean, I'm an owner of the business. I'm here to make money. But we're here to have long-term partnerships. the market is not efficient enough to make broad statements like that.
Right. That's a good point.
I mean, tax equity, the availability of tax equity is not available. It's not a very efficient market at all. And so those who have access to tax equity, access to EPCs, access to panels in the next couple of years, those are the people who are actually going to end up doing the deals. With the weighted average cost of capital, I mean, it kind of doesn't. It matters, but it's not everything.
Is tax equity less available today? Is that market efficient in this 2-year window that we're heading toward?
I mean, I think it's not available to the whole world like typical financing would be.
Less available to most people.
Yeah. The tax equity providers want to do business with people who they trust and who they have relationships with and who have proven in the past that they can actually execute and get deals done.
They're very conservative. They tend to come in late in the game, so you have to have a partner that's willing to take projects fairly far down the line before, you know, tax equity will get involved. I think one of the things I'll leave the conversation with and retain some time for questions is that, you know, one of the things that yield vehicles have done is, while reducing, you know, the cost of capital by whatever you want to call it, basis points, X basis points, what has happened is that it's opened the market in a way that it hadn't been opened before in terms of acceptability of solar energy and renewable energy as part of a mainstream asset class. And that has been key to the way that the growth of the industry will be affected in the long term. So even though it's not, you know, what developers will come and say to us is that you're trading at a, you know, X multiple, why can't you buy our projects for, you know, $1 billion? The answer is, well, we can buy more projects from more people and really have a mainstream asset class now.
Well, that's a great comment, because my comment about the dividend methods 2 and 3 about the MLPs, you know, the MLPs marketplace is a deep marketplace, but there's a 100 to 200 basis points of spread between all of them at some level, and that's an interesting asset class. We have the beginnings of an asset class energy has never seen before.
That's right.
And so then let me take a step back to the GTM comments yesterday about utility scale, DG, commercial. In what we've been talking about today, you know, are you sort of looking through the same lens at all those asset classes, or are you starting to think differently about the DG and smaller projects versus larger? Does project size matter here in this conversation today? I know you want scale always, but are you looking at risks differently?
Certainly different. Tax equity availability is different.
Right.
But there are some positive things to DG that don't get talked about, right? The ability to have different credit characteristics. You know, all you have is a basket of utility credits if you are only in utility. By the time you can get DG onto the field, you start to build a broader base and better portfolios with more diversification. So while there's a high hurdle, right? We need some sort of catalyst to kind of get there, to get the ball rolling. But once it's rolling, I think DG has much more potential to be a disruptive force in portfolio creation and thus in YieldCo space as well.
Can we get the mic in for our question? How many questions, any other questions that we want to touch? We've got a couple.
Yeah,
Here, we've got one here. Okay.
Thanks. I had a question related to this new mainstream asset class now that's very heavily valued by dividend flow. How do you think that there are risks for missing targets with this new asset class that might have a backlash in terms of the pricing of that asset class when this is not a dispatchable, it's an intermittent resource?
Right.
And I just wonder whether or not you think there's any risk there.
Can it absorb the hiccups when those hiccups come?
That's why we look at it on a portfolio basis. I'll stick my neck out here and say that. I mean, we look at it on a portfolio basis because we are anticipating issues potentially, and that's why, for example, our operations and maintenance and asset management requirements tend to be much more rigorous than what you will see from a different kind of buyer. So that is extremely important. I don't know about you, Chip, but the markets will punish us extremely heavily for a miss. And we don't plan to miss.
Right, and the way to help avoid misses is have enough assets at the DevCo level you can drop them in at the appropriate time.
Okay. Here's a question here, and then we'll come over to here.
Thanks. Curious about this. Do you see a path to the public markets understanding residual value, being able to value it? I mean, I think for the public experience with, say, a Solar City, it's one type of asset class, and they sort of stick their draw a line in the sand in terms of what those assumptions are. So it's easier to go and remodel those with whatever assumptions. The problem in a case of, I think, a more diverse portfolio of projects is that it's going to be sort of a case-by-case basis in terms of residual value. And I'm just curious whether you see a path to getting there where the public investor can, sort of look at a digestible set of facts and kind of do the math.
Right. Anybody?
I think residual value is implicitly being priced in, so you can make the argument that the public markets are already giving residual value.
I would say that half the valuation metrics are dividend growth models, and they don't look at all, as Chip was saying. They don't, they sort of think it's out there. But the idea is that SunEd, for example, has a very aggressive, Terraform, a very aggressive growth rate in the early years. But, that growth rate doesn't go on forever. At some point, there's a nominal growth rate in solar, which is, who knows what it is, but I think the conversation is, like an MLP, 6-8% growth. It's not, I don't see anybody looking at those, getting crazy about those cash flows out there. That's just my view of it.
If I may, the deeper challenge is that so many people still assume that there's an inflationary market for energy, whereas solar historically has been deflationary. And I think one of the challenges that we face internal to our company is grappling with solar prices just keep going down and down and down. And yet everybody wants us to assume some sort of, I don't care if it's CPI or 1%, or people want us to assume inflationary energy prices when we may be having this a sea change in the energy markets because of the deflationary effect of solar.
Deflation's real. Do we do one more, or am I cut off? We're a bit over here. One more question? Let's address, and then this will be the last one.
Hi there. Xenia, you brought up O&M, and I'm so glad somebody has talked about O&M on this panel, because I think this does kind of weigh into the managing the risk profile across these portfolios. Could any of you, especially I'd like to hear from Rob also on this, talk a little bit to how your O&M strategies can help manage some of the, looking at some of these better return rates you can get?
Sorry, what was the tail end of your question? How our O&M strategies do what?
Yeah, I'm asking, so how are the O&M strategies you have related to trying to reach some of these better return rates that we're looking at here?
Yeah, I mean, I think O&M is a growing market. There have been separate conferences on that and the proliferation of new entrants into the space. Main Street is part of our asset management function. We contract with third-party O&Ms. In some cases, we may self-perform the O&M. In some cases, we look to the EPC more and more, who wants to provide the O&M as part of a wrap on the project, post-COD for a period of time, whatever that is, 1 to 5 years afterwards. So de-risking the operational performance of the asset through O&M, through an EPC that's willing to take that on, and then having that long-term view. There's going to be no terminal value if you don't take care of the asset. So that's
Well, it is the most
100%
widely
important.
divergent assumption among all bidders is O&M. We're here in the early days.
O&M and asset management.
O&M and asset management.
So, I think I'll add to that that we, as owners and stewards of these projects for not only the term of the PPA, but for whatever assumption we're using for residual value for those projects, take that extremely seriously. And we think about what does O&M and asset management in terms of preventative and corrective maintenance look like. And that's a very difficult question to answer that I don't believe anyone in the market really knows right now. There's a lot of debate about it. But these projects haven't been around long enough for us to
I
really
agree.
know that answer. So there is a high degree of risk around.
You have to go to the rock to hear the answer.
You're not going to know the answer at the Rock because those projects haven't been there long enough.
The rock is there 24/7 knock.
Yeah, that's right.
Well, let me thank all of you. I think this was a very engaging conversation, and please join me in giving these guys a round of applause. Thank you.
Thank you.